I have the distinct privilege of introducing the Growth Investing Panel. If you can only attend one panel this summit, this is the one, and here is why. Number one, fact, investors are as active as ever, having put $538 billion in capital to work across 4,053 deals in 2017, according to PitchBook. Fact two, there is still significant dry powder due to record fundraising. There were $247 billion in capital raised in 2017, which is the highest since 2007. Fact three, in 2017, we had some of the largest tech-focused VC and private equity funds having been raised. However, this has resulted in challenges. Challenge one, finding quality investment opportunities. Challenge two, investors differentiating themselves from the pack. Challenge three, investing at prices that still allow for attractive returns to investors, shareholders. And so coming out of this, there will be a lot of questions that will be discussed in this panel. Question one, what sectors to invest in? Do you move up the growth and risk curve? How to build long-lasting companies in this environment? And what risk exists to the current 9-year economic expansion that we are experiencing right now? Fortunately, we have an all-star lineup of growth tech investors to help us answer these questions and many more. Joining us on this panel will be Cline from Vista Equity Partners, co-head of the Foundation Fund, and he sits on the fund's investment committee. Alan has invested in over a dozen software companies and currently sits on the boards of Lithium, Main Street Hub, Paylease, Social Solutions, and Upserve. Also joining us, Paul Barber from JMI, co-managing general partner. Paul has served on over 20 private, public, and nonprofit boards. Paul served as chairman of the board of ServiceNow from its original founding in 2005 through 2016. Vinny Letteri from KKR. Vinny is an MD in the Technology, Media, and Telecommunications Group at KKR, focused on growth equity investing in Americas and Europe. Vinny led KKR's investments into Calibrio, Jitterbit, Lyft, and many others. And moderating today's panel, Brad Weirick from Gibson Dunn. Brad is a partner at Gibson Dunn here in LA, and he is co-chairman of the firm's Emerging Companies Practices Group. Please put your hands together for the panel that we have in front of us. Thank you.
Thank you for the introduction. One thing I'd observe, I've been coming to these conferences for 15 years, and I've seen an evolution in the socks that people on the panel wear. They're more flamboyant year in, year out, and I've seen a correlation between the fancy flamboyant socks and the quality of the panels.
Play a positive correlation.
I'm not sure we're really pulling it off. I mean, I think Vinny's doing okay, so we'll try and do our best despite the poor socks showing. Tej sort of set the tone. I mean, everybody's heard the story of the phenomenal growth in growth investing, the growth in the number of mega growth funds, the number of unicorns out there raising money. I think I saw somewhere that last year there were 73 unicorn financings involving about $19 billion of funding. Another phenomenon is, unicorns are staying private longer because there's availability of capital, and so they don't necessarily need to go to the capital markets. And then, everybody seems to be moving into growth investing. You've got VC funds that are sort of moving up into growth. You've got people on our panel that, may more traditionally be private equity investors, and they're also focused on growth. You've got hedge funds focusing on growth. You've got corporate venture capital and, maybe another influx of capital with the repatriation of offshore funds, bringing more billions of dollars maybe in to the country and available for investment. And I presume that's, inflating valuations, creating more competition for deals. So that's the context for this panel, and I think we've got a great panel to talk about those topics. Alan, why don't we start with you? what's your explanation for why there's so much focus on growth investing, and why is everybody seemingly turning to growth investing? Why is it sort of the hot space?
A great question. I think there's a confluence of factors that leads to kind of where we sit today and why that's relevant. First is, as you pointed out, huge influx of capital trying to find a home for good returns, and in a low interest rate environment, equities are looking better and better and better, and for 9 years that's generally been the case. I think the kind of frankly unabated bull market for 9 years has also helped people look at to say, let's be a little more aggressive with our spending. And then frankly, as we look across our portfolio, the performance of folks and the fundamentals of their underlying go-to-market strategies and selling has been excellent. So I think that from our perspective sets the stage for, there's a huge opportunity. And then by sector, you're going to find different things where, a number of companies are still going through replacement cycles in their markets. Frankly, this underlying SaaS movement is still, call it plus or minus 10% of software is SaaS, and so there's huge amounts of opportunity. And as each market moves into a replacement cycle, you're seeing opportunities for great growth. I think we can talk a little bit later about the definition of growth. Kind of growth is a pretty wide and somewhat abused term in terms of what it means. For us, it's generally folks that are growing 15 to 40%, or I would put in that kind of good growth category, and then anything above that, I think you'd put in the excellent growth category. And with that, I think you can find great investments over a period of years if you can sustain that. So I think that's why lots of people are interested in it.
Vinny, KKR has a pretty decent franchise focused on traditional private equity investing, and the natural question is, why have you turned to growth? Why is there a focus at KKR on growth investing, given the franchise you've got and how well that has done?
Yeah, this is a question that we get a lot, given that there's no shortage of growth capital out there in the market. The last thing the world needs is another growth investor. But as I sort of think about this question, there's some things that are probably KKR specific around this, and then some things that are probably more generally applicable. We're relatively new to the growth equity space. We started our efforts formally about 3 or 4 years ago. But really the seeds of our entry into growth were sown about a decade or so ago when I started at the firm. And we made a decision within our tech buyout team. Traditionally, we have been focused on what we called financial buyouts. So this is looking at large, cash-rich, legacy, stable tech businesses, put leverage on them, control costs, grow them a couple % per year. You can make a nice return. And we decided to shift towards more growth-oriented buyouts. So companies growing 10, 20, 30% a year, like a GoDaddy, a Mitchell Software, which Paul was involved with, internet brands. And through that process, we've kind of learned how to use the assets of the firm to help these growth companies, and also developed a new set of capabilities around maintaining and accelerating growth. And so we naturally took a step back and looked at where can we apply those sort of skills and capabilities. And when you looked at what was happening in the private markets, with companies staying private now, depending on what data you look at, between 11 and 12 years, you look at the amount of value creation that's happening before those companies go public. It was just natural for us to say, this is a market, we don't have a pool of capital available to invest in. And so we did. And then the last piece for us is we do a retrospective every year where we look at the deals that we didn't do, and did we get that right, did we get that wrong? And then the deals that we did do, did they end up the way that we thought they would, or is there something that we learned? And over time, as we looked back over that, we saw the single biggest mistake that we made was when we invested into companies on the wrong side of the technology adoption curve. We didn't see a big tech shift happening in the marketplace. And so now, having a team like mine in place, we now have 13 people at the firm who all they do is focus on these smaller, faster growing companies, and it helps inform our decisions on the PE side of the business as well. So it creates this nice positive feedback loop for us, helping the overall franchise.
So Paul, JMI has always been in growth, traditional growth fund investor. I guess the first question to you is, what's your perspective on all these other players sort of, maybe you could say, invading your turf? Does it make it harder for you to find the right deals and get into the right deals with so many different players, suddenly in the growth space?
So first, thanks, Jamie, for having us. It's a great conference. Fun to see everybody here every year in Santa Monica. So JMI Equity, we're growth software investors. Our belief is that business-to-business software companies in the growth stage can deliver above average returns for our investors, institutional investors. And it's the growth rate that drives the return. You can go look at the data that says a company, if we can compound our portfolio, we have $1.6 billion of value in 30 assets growing organically at 25%. If we can grow our portfolio organically at 25% for 5 years, we're going to have a lot of nice returns for our investors. So, we're very focused on business-to-business software, so focus helps. We're not generalists. The world has just exploded with the cloud. The number of companies, there's so many more companies than there were 20 years ago. And with the cloud, companies can stand up faster and emerge faster. So there's more competition. It was competitive 19 years ago. We had an $86 million fund. I called it, 3 guys and a smart dog. But everything was competitive in 1999. It's competitive now. There's more companies. There's more competitors. And so I think it just breeds that more and more of us have to be focused. So where do you want to spend your time so that you have an opinion, so that when you do have an opportunity, you can move fast.
Talk a little bit about your sweet spot for growth portfolio companies, right? I mean, you've got to find a company that has proven its business model. It's got real revenue. It's not just some concept, and it's ramping up, but maybe not quite profitable yet, and needs your capital because you've got a lot of capital to deploy. So talk a little bit about how you find companies in that sweet spot and your process.
Yeah. So fund size drives check size, which drives the kind of the rhythm of the business. So we have $1 billion fund. We're trying to make 20 investments. So our average investment's between $40 and $50 million. On average in our current portfolio, the companies are around a $20 million run rate. So we're not the 0 to 10 folks anymore. We're the growth phase. 60% of the time, we're first institutional capital, minority investment into a founder-owned business. Sometimes they're profitable and they actually want liquidity. Sometimes they're growing and want our help. And so we think a lot about what's the check size, what's the TEV that we get in at. Most of our exits are $300 to $500 million. They're not unicorns. So we think a lot about, can we get in at around $100 million enterprise value so we can run our growth playbook, grow the company organically from 20 to 100 million. And then generally these guys show up and when growth slows down, they become very profitable. And then either a strategic buyer comes along or one of the tech buyout funds.
So the KKR and Vista growth investors are not really coming in and competing with you. They're really more your...
I'm sure we could, we track, so in our current fund, we've looked at 150 deals at investment committee. 2/3 of the time, 100% of them, there was competition. 2/3 of the time, there's a unique competitor. So there are a handful of people who are focused on software. There are a handful of people who have the calling effort like we do. So we see people like Insight the most because they call the most companies. But generally, by the location of the company, the sector of the company, and the check size. So it ends up the competition's fragmented.
This is, I guess, for Alan and Vinny. I mean, I guess I'd like to get you to give a little bit of your perspective. What's the difference, the key differentiator between a private equity investor and a growth investor in terms of how you're structuring your deals? And there's obviously, the minority investment versus control issue, and everybody knows that. But I mean, is there other key aspects of the investment that you can describe? I mean, for example, are you not wanting co-investors in your deals? Are you wanting to be the sole minority investor in a growth investment? What's your perspective on strategics being a part of the mix in your investments?
So good compound question, so you have to remind me the second half of that later, maybe Vinny takes it. But on the first part, when we think about where we're going to get involved with something that's going to have the growth moniker to it, it really is something we turn around and look from the company's perspective and say, hey, when has it gotten to the size and profile and the needs of the business are a good fit for Vista? And that generally is a combination of a few factors. One, to Paul's comment, they've gotten to that size and scale where they can do more than just think about, the core product and business that they invented originally. So it's either other products that they build, or is it now time to think about doing some complementary M&A, either product-wise or geography or whatnot. That's usually one driver where it kind of moves into our sweet spot. The second would be where the company gets to a point in size and scale where they say, you know what, I like what we're doing. I'm just not 100% confident. I know how to do the next part. And sometimes that's a operational scaling component. Sometimes it's frankly team. Like the team that got me here is not going to get me there. And they've been great, so help me with that. Sometimes there's a desire for some liquidity. They've been working really, really hard for a decade. They got kids going to college. Maybe it's time to de-risk a little bit. And those are situations that I think for Vista fit us extremely well, where we can come in and be, frankly, tailor-made for that kind of multifaceted decision-making process for the entrepreneur and the current owners. To the second half of the question, we are, I think for probably till about 7 years ago, we did not work a lot with other investors just because we felt like there was a simplicity of, purpose of management plus one investor being able to make decisions and move quickly. I'd say in the last 7-8 years, we've gotten, frankly, extremely flexible on that point. We've done, I'd say the majority of the deals I've done have been kind of majority recap, where an existing investor is taking some money off the table. The founding team is deciding to sell some or all of their current stake, and then they're re-upping for the next part of the journey. And that has been a great fit. So I think we're now in a world, almost a decade, where we've been very open to other investors continuing in the business.
We probably have some corporate investors in the audience. I mean, so I don't know what you're comfortable saying, but how comfortable are you with strategics coming in as co-investors in your deals with their obviously differing perspectives, differing motivations potentially? And are you doing a lot of deals with strategics as co-investors in your deals?
Maybe I'll take that one. So I'd say each situation tends to be a little bit bespoke, but the most important thing for us, most of our situations we are investing with other institutions, and the most important thing is there alignment of interest between the different parties sitting around the table, both the early stage investors and then potentially any strategics. And some of the key questions that we try to ask is really, what's the motivation for the strategic coming into the round? Is it to get access to a new technology? Is it to lock up exclusivity from a competitor? And it's really important that we sort of understand what's driving their desire to invest in the company, to make sure that we're all aligned on what are the sort of strategic imperatives, but also what's the end outcome that we're gunning for behind that. And then I think the second big piece for us is, are they just a source of capital? There's no shortage of that out there in the marketplace. Or is there something value add that they can do? And do they have a history of providing value to the investments that they make? Those are sort of the important things that go through our mind when we think about that.
We've done a few of those. We did ForcePoint, which is a business formerly WebSense, that had made a few acquisitions. We then sold and rebought into what is ForcePoint with Raytheon. And their goals were to say, hey, we're a big defense contractor. Software is super, super important to our future. We'd frankly like some help as a co-pilot in terms of continuing the strategy that you guys already had. And so we worked out an arrangement that works well to align those interests with a corporate in a really unique transaction. And then my meeting tomorrow in New York is with another strategic that was about to try to close a deal, and they decided there was too much work to do to kind of make it acquirable on their own, and so they're asking us to take a look at it and then what they want to do is put in place a partnership and then have a right of first offer to buy it 2 years down the road. And so we're if we can get that good alignment of incentives and feel like it's a good kind of time value equation, we would do that again.
So once you're invested, I guess maybe Vinny, you start. I'd like to get a little discussion going about the differing role of a growth investor in these companies as contrasted with traditional private equity investor investing in a big company with a lot of leverage, and maybe the role of the investor is to help make the company a little bit more efficient, maybe some financial engineering, as contrasted with an investment in a growth company, which is an entirely different animal. A lot more mentoring, a lot more focus on different issues. So, give
Yeah,
your perspective on that.
I think there's some similarities between the two, but the more interesting discussion is where is it different. I think, if I put my PE hat on and think about the companies that I helped invest in there, a big piece is around managing. 99% of the time you're putting debt on the business, and so an important piece is managing sort of that leverage piece. And so it's around controlling costs, making sure that you're keeping a handle on sort of cash flows of the business, making sure you don't break any covenants, et cetera. On the growth side, the key things, at least in the businesses that we invest in, a lot of it is building sort of the back office infrastructure, so the financial reporting, the legal, the compliance processes to help these businesses scale, either in their current geography or new geographies. Oftentimes we're building new parts of the business. So that may be a corporate development function that can go out and make acquisitions that traditionally hasn't been a part of the company, putting in place metrics and reporting that maybe weren't there ahead of time. So it's a lot of that stuff sort of behind the scenes that you don't necessarily see, but that are important to help drive the growth of the business. And then I think that the last piece for us is, as you mentioned, Brad, most of the companies that we're investing in, you have either first-time founders, first-time CEOs, and providing sort of, whether it's via us or advisors, a mentorship, a coaching role to those people as they're sort of growing their businesses. On the PE side, you tend to have people, it's not their first time sort of doing this as a manager. And so there's sort of an experience level there implicit in the company that you're buying that you just generally don't find on the growth side.
Paul, I assume you see that as well. I mean, I guess there's some aspect of growth investing that involves a lot of sort of the unsexy part of it, which is just building the infrastructure, building out finance, compliance. I mean, some of these companies presumably don't have any of that when you come.
Oh, for sure. So for us, we're probably a little earlier than the other two, that they're generally technical founders who by force of will and personality created a business. They're not professional. And so half the time we get agreement to bring in a professional CEO, half the time we build a team around that technical founder. And it's all about getting the right people for that next phase of growth. And the two key disciplines in a software company are the go-to-market, the sales, and the product. And generally, young companies, it's all in the founder's head, and it's by force of will and personality that they sell, and you can't scale that. And so we always bring in a professional CFO and work on some of the back office, but it's really getting the right people for the next phase of growth. The founder generally either wants to stick with his brother-in-law or they want to go hire a resume. And it's getting the right person for that 20 to 80, phase.
Yeah. Another obvious important question with growth companies, and maybe this is for you, Alan, is how you strike the right balance between getting your company to profitability and growing to grab market share, investing in customer acquisition. I mean, there's no easy answer to that, obviously, but I mean, talk a little bit about how you strike that balance and make those decisions.
I think that's a good question. I'd probably almost separate out one group. There's some companies that are in a land grab where the rents for winner-take-all economics are worth spending your way to a victory. That's generally not our profile. Like we've got some companies that have high growth, but we're not going to lose 100 on a company making $50 million in revenue to try to grab share, right? So let's exclude that from the mix because that's not where we focus our time. And few companies are probably well positioned to do that. Where we generally look at it and say, hey, we kind of look at the rule of 50 and say, hey, if you can kind of have a combined organic recurring revenue growth rate and your EBITDA margin adds up to 50, you're frankly a great company. And so we would prefer to have, particularly if it's available to you, I would take a point of growth over a point of profitability any day of the week. And the question is, how much further beyond that would you go? Would you trade 2 points of profitability, 3 points, 4 points to get 1 more point of growth? And it really depends on a lot of factors, frankly, around retention rate and the lifetime value of the customer in terms of how far you dip that down. But we always want to have that conversation around, let's grow as fast as we responsibly can, and then try to focus on something that is very, very hard to measure, which is your marginal cost of customer acquisition. It's almost impossible to try to figure out exactly how that last dollar is performing. But you want to look at that and say, hey, is that last dollar a good dollar to be spent on acquiring the customer, or are we better off putting it in our pocket? And then generally when we're getting a good example is actually a business that JMI had sold us, which was called Autotask, that they'd done an excellent job building up to basically the low 30s in revenue. And then they got to a point where it was still unprofitable, but growing. And the question was, how do we make it sustainably growing at a bigger scale? And that's where the team could really have used some help. And it came on two dimensions. One was they were now of the size and scale where they could talk about doing some M&A. And so we made 2 acquisitions to help them inorganically grow. And they were pretty small, but it basically expanded how much we could sell through the sales force organically post those acquisitions. And we looked at it, and every board meeting was spent a lot of time trying to make sure, okay, have we reached the edge of our growth curve or not? And if we hadn't, the decision was we're hiring 10 more salespeople. And we did that until we got up to about 160 salespeople. And then that's kind of where the story is today. And it's still probably not at the full edge of their growth curve, but that's the discussion we had to basically balance it. And then as we got into the 3rd year of the investment, the view was we believe you'd like some profitability, partly so if you're going to look for another financial sponsor exit, and you've got that as a backstop. But our view was there's more likely a strategic exit, and they're going to place a higher premium on the growth. And so we didn't want to tilt it too far to profits and still made a pretty heavy investment in growth. But I don't know if that helps with one example.
Vinny and Paul, other perspectives on that?
I think we're pretty similar to what Alan outlined. I mean, we spend a lot of time in our investment committee thinking about sort of the unit economics of the business, both what does it look like today, and then trying to project forward what does this look like at scale. And we think about, is this a white space opportunity, or is it something where they're displacing, a legacy competitor, and what should the sort of spend levels be associated with that? We generally, as sort of Alan mentioned, we avoid generally the super high cash burn businesses, Lyft being the obvious counterexample to that, which we're large investors in. But outside of that, we tend to be we look at it saying, do we think we'll get a good ROI on this investment overall? And if so, we think it's worth doing. And that said, I think one of the nuances or the places where we spend a lot of time with our companies is we think that there are ways to continue growth while also improving profitability along the way. And so one of the pretty consistent areas that we find opportunities in our growth companies is in the area of pricing. Most companies early on, their approach to pricing is, we'll just take whatever we can get. We're just trying to survive. And we have a couple of folks internally who ran the pricing practice at McKinsey. We bring them in to help our companies think about that. The stat is for every 1% increase in pricing you can get in the marketplace, it generally results in a 14% increase in bottom line impact. And so if you can put in things around that can keep growth going, but improve discipline around discounting, thinking about how you optimize renewals, pricing, et cetera, you can keep that growth going, but also improve your profitability at the same time.
Mm-hmm. What about M&A? Maybe Paul, talk a little bit about the M&A piece of growing your companies.
It's not a huge piece for us is the short answer. So most of our businesses are growing, when we invest, they're growing 30 to 50% organically. And so we're, for the most part, running an organic growth playbook. We selectively do some buyouts and recaps. Those are the kind of businesses where we do generally what we call tuck-in acquisitions, where we can add more product that we can, sell back to the customer base. But JMI is not really there's some people who are in the platform, put platforms together. We're more in the organic growth space.
Our view is everyone needs to run their own race. Some people are going to, I think some people are going to be hitting a growth curve, and you should be very, very focused on staying on the highest part of your growth curve. And if that doesn't, organically, and if that doesn't include M&A to distract you, then that's the right answer for you. We've got a number of businesses, probably the majority of our portfolio, that when they've gotten to a certain size point, and as Paul mentioned earlier, growth is no longer, it's now not 40, it's now 25, and the company's not 20, it's 80 million in revenue, or even frankly even smaller than that. We've found M&A to be an enormous value creation tool. It has allowed us to buy competitors, buy complementary products, enter markets faster. I think how you execute it is the most important thing, because it's pretty easy to buy something and destroy value if you're not careful. But
I was going to say, from my perspective, I'm often on the outside working on the deal. Yeah. But I can't tell you how many deals that I've worked on and then I hear after the fact, 6-12 months later, that didn't work out. Everybody at the target left. We didn't integrate it well. It cost a lot more to integrate. And then the distraction factor at the acquisition business, taking their eye off the ball on what they're trying to achieve in their business, trying to then integrate some other business. And so, it's such a delicate.
That's where you really need the help. We've done over 100, and it is, we screwed up the first one, just to be clear. And we left it alone. We were like, we didn't complete the integration to make it one business and have everyone put on the blue T-shirt for the same company and all start working together fast. We thought we would harm the business by doing that. And in fact, we did the opposite. We harmed the business by leaving it alone. So we taught ourselves, fortunately, an early lesson on that front, and it has been one where I think if you are thoughtful and clear-eyed about why you're going to do the acquisition and what you can and cannot count on, and then commit to it as part of your managerial focus, and you have the bandwidth to do it, and you get good advice on how to handle different pieces of it, I think it can be enormously powerful. But if you don't have that help, I think you can mess it up pretty easily too.
That's probably a good segue to the topic everybody wants to talk about, which is exits for your portfolio companies. I guess maybe this isn't applicable to your portfolio companies, but sort of the billion-dollar question is, with these unicorns raising funds at higher and higher valuations, as a general matter, are the growth funds going to realize the returns that they're hoping for with these valuations already where they're at? Maybe Alan, go first, or anyone else, or is there some risk bubble out there with these unicorns that we're going to see pop here? What's your take on all that?
Paul may be best positioned to handle that first, but it depends, right? So I think there's going to be funds like a JMI that are very focused and are picking a part of the market where they know what they're doing, and the size of check and the size of investment layered against where exits are actually occurring. I think that model is going to continue to work extremely well. I think the harder ones are where you see folks, we'll talk about SoftBank later, but people piling, they're piling, I'm no disparagement to SoftBank, but $300 million in the dog walking app, I haven't been able to figure that one out in terms of where you're going to make, kind of the great return. Now, super smart folks, so they can explain it to me later, but we're seeing some of those rounds where people are raising. We got one of our companies, their number one competitor raised $100 million. Their goal is to basically put it to work in the next 18 months, but it's not a super fast adoption market. And so I think there's going to be a lot of wasted, a lot of wine spilt on the floor while they're trying to spend money faster than the market can absorb it. So I think if you're smart about it and focused and really kind of know where your sweet spot is, I think it's wonderful. I think we'll talk about SoftBank later, but I think certain instances they're going to they're going to pick winners, and they're going to be right, and their capital is going to make a huge difference, and others, I think, we'll see.
Paul,
So in the software world, over 25 years, 80% of our exits have been sales to strategic buyers. It used to be 20% went public. In the last 3 or 4 years, half of our exits have been to the big PE buyers, and then half are still strategics. And so very few IPOs. So if you have a software business that creates recurring revenue, there is going to be a home for it. But certainly as an investor, if in the B2B world, there are not a lot of billion-dollar outcomes. And so in the B2C world, there are a few huge winners. But we're not in the unicorn business for a reason. We've kind of voted with our feet, because in the B2B world, there aren't a lot of billion-dollar outcomes. But and so we think about that a lot as far as where we spend our time. But in the B2C world, there's some people who've been very successful playing for big game, but that's not the sport we play.
Yeah.
And I'd say, I agree with Paul. I think you're going to see more and more exits to large PE firms sort of over time. I think that's a trend that's going to continue to grow given the capital that's out there. And I think probably one area where we're probably non-consensus with the rest of the market, maybe this will liven the conversation a little bit. We think it's a great time to go public. Frankly, we've taken over a dozen companies public over the past year. We think the markets are at an all-time high. Really good technology companies are trading at really good multiples. I think that the key there is sort of really good technology companies. And one of the things that we see a lot of the companies that we look at is you see investors rushing to get a name on their website or something like that, and then not having the conversations with the company around what does it take to actually be a public market candidate. Eventually, at some point, you have to generate a profit. You have to have good economics. You have to have a strong management team. And we don't see a lot of companies sort of making that bridge from where they are today to getting themselves sort of in shape to do that. And you hear a lot of noise around, some companies that have gone public that haven't done as well as maybe they had hoped. And I think when we look at those businesses, they fall into this category of they didn't, to use the analogy, get into the gym to get fit. But we think that going public's a great option for companies. We're not afraid to do it. And we're kind of surprised that so few companies have opted for that route.
So do you see a change coming? I mean, I think the stats show that there was a little bit of an uptick this quarter in IPOs. Last year was not so many, and it seems to be stalled out. Do you see that changing?
I don't. I don't. I'm not of the opinion that there's this big backlog of companies that are eventually, going to go public over the next couple of quarters. We've looked at a lot of these later stage companies, and we've looked at sort of their financial position and where they are, and we just don't think that they're sort of fit or viable to go public. And so, I'd say we disagree with the consensus out there in the marketplace that there's going to be this huge rush to the public markets for these companies.
What's your take on this Spotify direct listing idea? It's interesting. It's actually something that is not necessarily novel, because if you get big enough and you have enough shareholders, the SEC may declare you a reporting company, and then maybe you search around and find a way to get your shares listed. So that can happen, and it has happened. So it's not new in that sense. But, it is interesting, and it'll be interesting to watch Spotify and watch what their share price does, and, how they peg the price if they do this. Any takes on that?
I think it's going to be more the exception than the rule. I think, if you're going to do a direct listing, you got to have a brand like a Spotify that people are going to identify with and want to own without anyone helping communicate what the story is. The direct listing for Spotify, if I understand correctly, it's just that. It's direct listing. There'll be no extra capital raised for the company. There'll be, at the time, it will be just the listing of the shares and then kind of starting trading at whatever level that occurs. And there's more to, I think, having a well-run public offering than just now, quote unquote, being public. That I think if you're not Spotify and you are capable of going public, I think a more traditional process is still preferred. So I think it's going to be the exception, not the rule.
Yeah, I mean, the whole process of finding investors that will support the stock, building out the book, I mean, they're just, and running that, and maybe it works for them. It'll be fun to see.
Yeah, I think the ironic thing there is if you actually get into the details, I mean, Spotify still has 3 investment banks they've hired. They're still paying $30 million in investment banking fees. You know, you can call it a direct listing. I mean, the banks are still involved in that. And I think you heard a lot of noise, similar noise probably back when Google went public. You know, they went in a very unique way, and there was this buzz, are more companies going to follow this model? And I think, like Alan said, the reality is these are pretty unique examples. There's a handful of franchises I think could follow what Spotify's doing, but I think in order to do that, you have to have a well-known global brand, most likely in the consumer space, where there's not an education process around what the company does or what their value is, and I think those are pretty few and far between.
You also hear talk that folks say that it's sort of a bad thing for our innovation economy generally for these large private companies to be sort of sitting there raising private capital and not going public because of all the founder value and employee share value that's locked up, although there's ways to realize value more and more these days. But that all that value is locked up, and that's a bad thing generally for the tech world. I mean, anybody have a take on that? Paul, what's your...
Oh, I don't think, I think private equity have been great owners of assets. I think that, you know, that we've selectively worked with the larger firms, and when you go into a team and you have one shareholder and create alignment and have one mandate, you know, we've created real shareholder value and have built some great businesses. So like we're an investor with Hellman & Friedman in a company called Kronos. It's a 40-year-old company. We took it private 10 years ago. And we've reinvented the company as a private company, not having to worry about quarterly cash EPS. We just invested $150 million to build a cloud platform to go take our 7,000 customers to. It would have been very difficult. I mean, Concur did it. That's, you know, a couple people have done it in the public realm, but very hard to do. And so I think, you know, you can not have that sometimes being a public company, you're really tied to creating long-term shareholder value. And the other thing is just alignment with teams. You know, when you have a simple capital structure, a simple governance, the big PE guys, I think, do a very good job of that.
Yeah. Maybe Alan, talk a little bit about how you decide where is the right point on the company's growth curve to exit. I mean, you talked earlier about the decision between growth versus profitability, and
yeah,
I guess it depends on who the buyer is as well.
It does.
Or private equity.
I'd say there's 3 factors that we kind of look at the most. Where are we in our cycle to drive returns we're trying to drive for our shareholders is obviously plays in. The second is that what's the fundamentals that you can drive in the business to your question on the growth curve. And the third is how's the market doing? And so we always want to try, and the problem is you're trying to guess at least 6 months into the future, if not longer, as to what's going to happen. And that's, you know, if not impossible, that's very difficult to do with any, you know, high degree of certainty. So we look at that and say, hey, if we've got a business that we believe has got, you know, a growth curve that we can keep sustaining. I think that sustainable growth is the thing we probably focus on the most. To Paul's point earlier, it's that growth rate that is going to get you the highest premium if you can maintain it. And then you want to have a really clear story for whomever the next buyer is on how they're going to make their money in the next term, next 5 years, whether it's a private equity firm, a strategic buyer, or whatnot. And when you feel like you've got your acceptable return covered, the opportunity for the next buyer to make money and the market's hot, you know, we have decided, and we had a handful of exits in the last year, we felt like the time was right. Like that combination of factors felt good. Some of those we sold outright, and some of those we actually did a majority recap and maintained a stake so we could continue to participate in that growth curve. But those are the 3 things we look at, and you know, it depends, and all 3 matter.
Any other perspectives on that, Benny or Paul?
You know, I think something that we think about is we want to be known as good sellers of businesses. So there's got to be another leg of growth available for the companies for the next buyer. And as we think about it, there tend to be natural points. It may be a company that's going from, a license to SaaS transition that takes 3 years, and you say, we've been in it for enough time, the next sort of owner can take it through that transition. Or it may be, the growth is really in international markets, similar thing, that takes a few years to build out, so it gets beyond sort of our investment time horizon. But there's got to be something there where we feel like there's a story that we can share with prospective buyers around where we think sort of the opportunities are on a go-forward basis. And it's definitely more sort of art than science. You're juggling a bunch of different factors at any given time, but the overarching sort of first principle for us is we want to be known as good sellers of businesses.
You mentioned SoftBank, and we touched upon it. I mean, I think it is just fascinating to ask how some of these gigantic funds are going to put out that capital. I mean, how do you manage that much capital? How do you put it out responsibly? How do you staff it? I mean, I don't know. You Alan raised it. What do you think?
I mean, I think, if you're going to, the size of some of the checks they're writing into various businesses, I think putting the money to work is apparently not going to be the challenge. And then Maso was quoted as saying he has a 300-year time horizon. So it's always good to make sure that the measurement point is after the lives of everyone you're speaking to has guaranteed to be over. Now, all kidding aside, I have no idea. I mean, I think this is an interesting question. I think it's one that it's really interesting to see how they're doing it, and I felt like Dara at Uber said it best. I'd rather have their hundreds of millions of dollars behind their cannon behind me than pointing at me. Yeah. I agree with that entirely. How it turns out as an economic proposition, I think depends on how they're structured. I think it depends on how they're kind of pushing companies to use the money and is it done responsibly. You can easily overspend your market opportunity in some of these businesses, and those they won't get a return of capital on. But if it's a big opportunity and it's structured right, they may make, if you're investing $100 billion, what is the rate of return you need to have that be a good investment? These days it's pretty low because where else are you going to put $100 billion all in one fell swoop?
I don't know SoftBank at all, but in the end, you're either an asset manager or you're an investor. And we're trying to be an investor and get the highest multiple of the money. And if you're an asset manager, you're just playing a different game. Yeah. And they're clearly in the asset management space.
Yeah.
Yeah, I think what they've done so far is pretty different from what we thought they would do. We thought that they would be more competing with our buyout business to deploy, $100 billion. We sort of thought they'd be doing more deals like the AMD deal and sort of others. But, I guess we have probably a slightly different take on things here where I think our point of view is there's very few businesses we can think of where we think of capital as a sustainable competitive moat for a business. And if anything, if you look at different areas of sort of life, whether it's professional sports, you see these athletes that they get $100 million and then they become sort of fat and lazy. I think it's really hard to be disciplined when you're getting $300 million as a dog walking app and putting that capital to work. And so I think there's opportunity. I think that actually presents a bunch of opportunities for companies to differentiate themselves that are competing in that way. Either with a unique value proposition or something else. But I think there's a few businesses, but there's not many that we think that capital can actually serve as sort of a barrier to entry or competitive moat.
Mm-hmm. We're getting down towards the end here. So I guess what I would do next is, because it's always interesting to an audience like this, is ask a group of investors like you just sort of what things in the growth space, what technologies and businesses are most exciting to you, and just share your perspectives. Maybe just going down the line or start
the cloud. It's hard to overstate what an opportunity the cloud presents to the whole economy. And for our investors, one of the things we point out is, Amazon breaks out the AWS numbers now. It's grown from zero to a $20 billion business organically. And there's been in the press recently what Oracle's doing, what Microsoft's doing, what Google's doing, all the capital investment to create the infrastructure for all these workloads. And you can't overstate, there's hundreds of ways to play that theme, but that's the big mega trend in the business-to-business world.
And that's just reinforcing the ability of and the need for these growth companies to raise capital and grow fast, and it enables it with the cloud and their ability to go on Amazon Cloud and ramp up quickly.
Right.
Alan, what's exciting for you?
Yeah, I agree with Paul. Like, there's so many other things people are talking about, but the cloud transition is still, from a reality standpoint, is here now. It's big. It's continuing to make waves everywhere. There's other things that get more buzz now because we've been talking about the cloud for a decade. We're trying to make some investments in what I would call the kind of earlier technologies that will eventually impact our portfolio in a meaningful way, but being realistic about when and where that's going to make a big impact. And so we've got a team of 6 data scientists working on basically a bunch of AI and machine learning applications in the portfolio. Not all of our companies are going to be able to bring a product to market that is going to generate revenue off of that in the next year. But our view is, if you don't start exploring it now, 3-5 years from now, when it could be impactful to your business, will be too late. And we're also investing very similarly in some of these things I tend to think are a little buzzwordy, but while we're not going to do an initial coin offering, we are investing a bit in the underlying research around blockchain applicability to a variety of our portfolio companies. Again, not applicable, in the next year. But our view is, as a portfolio, we got 51 companies. We can invest at the Vista portfolio level in a lot of the more forward-looking aspects of those businesses that we do think will have big impact. And then how do you blend that into a revenue-generating product that drives client value in a sensible way? Because we're not doing it because they're buzzwords. We're doing it because we believe the underlying future of those things will have big impact.
I thought we could get through 50 minutes without saying blockchain, but we couldn't do it.
And I'm embarrassed to say that. I was the one who brought it up. But,
Maybe this is the last question. Vinny, what's exciting to you out there? What are you guys focused on?
Yeah, I guess a couple areas. We spend most of our time in enterprise software, in particular in sort of vertical applications where you have broad-based sort of platforms that serve sort of general mass as well, but don't serve the needs of specific audience as well. And so we spend a lot of time in there. I agree on the cloud point, though we also think there's going to be, if you look at history, there tends to be a move from sort of centralization to decentralization that tends to oscillate back and forth over time. If you think about mainframes to PCs to phones to cloud. And we think there's going to be some interesting things that happen on the edge now as you think about whether it's autonomous vehicles or IoT devices where, at least with today's technology, the latency you get from sort of cloud applications, you don't want a 5-second latency when a kid runs in front of your autonomous vehicle. And so you're going to need high compute at the edge. And at least today, I don't think cloud can sort of get there. Maybe it will sort of with quantum computing or other things. We spend a lot of time in fintech as well, though not in sort of the blockchain or ICO space, but we think that's in particular around sort of fraud as more and more, both fraud and cross-border transactions, as you have things like whether it's Amazon, iTunes, others, where Airbnb, where you have buyers and sellers across the world who need to facilitate those transactions, as you have chip and PIN coming to the U.S., more and more frauds moving online. So how do you and just general shopping's moving online. So how do you think about sort of fraud? And then the last space for us is just around application development and sort of the DevOps space. As you see less consumer-facing applications and more internal applications, how do you develop, release, test, and sort of manage those things on an internal basis? Companies generally don't have that skill set, but that's where we are focused.
Well, I think we've pretty much nailed it on the time clock. We've been told we're done, but that was great. I appreciate you guys being on the panel. It was hopefully helpful, and thank you all for coming.